schedule. I thought Jeremy was joking when he called me. Yeah.
So much for that early start.
And I was here earlier. I left at 4:30. Yeah, it's like.
That's all right. At least we're having it, because that would have been bad.
Okay. Hopefully this is the last time I ever do this, because I got everything else under.
We're all good. It's been.
Yeah, it's good. I'm just glad you're here.
Oh,
I'm gonna be here.
I heard that.
Guess not. Man, who knew we had to make attendance?
hey, we get to sit next to each other.
We can get in a lot of trouble.
I knew Papa.
Behave yourselves. These things are live, all right?
I forgot.
Throw me that stuff.
All right, everybody ready?
This is yours.
Yeah. If you don't mind.
Got your names figured out? Sitting there. It's fine.
I think we're good. It doesn't matter. Yeah.
All right, let's start with the Pledge of Allegiance.
Allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
Vicki, would you mind doing the roll?
Yes, Commissioner Blaney,
Present.
Commissioner Good,
Present.
Commissioner Biggs, Councilmember Rivas,
Here.
Councilmember Graham,
Here.
Councilmember Jessen,
Here.
Councilmember Brickner, Councilmember Paprad, Councilmember Sims,
Here, finally.
Councilmember Blazer, and advisory members.
To save the day.
Mark Besley,
I admit, Greg, we couldn't have done it without you today.
Oh, it's just, I honestly, I have no, I apologize. I just did not have it on my schedule. There's no reason.
You know what, before we even start, should we schedule the next meeting? Because I didn't have, the first time we had this scheduled for on my calendar. This thing is so loud compared to before. Okay, what is our timeline that we need to make happen?
What would it be? You think we'd need to meet in the
September?
next 30 days or the next 60 days or the next 90 days?
Well, we need to talk about, I guess we should wait till the end, see how this meeting goes, and that'll answer that
Yeah.
question.
Yeah, I
Okay.
think so too.
All right. Let's start with approval of minutes. Do I have a motion?
So moved.
We've got a second and a motion.
Second.
All those in favor signify by saying aye.
Aye.
All opposed, same sign. Motion carries. New business, we've got the Capital Cities presentation.
Okay. Good evening, everyone. Great to see you all. Thanks for joining us. What I'm going to do is cover the report and the performance pretty briefly. It's all really great news and continued good news even through the current times, so I'll give you an update on that. And then we've got some materials in the back that I want to touch on, and we do have one small recommendation of a tweak to your fixed income portfolio. It's not huge, but it's small, and it will require a vote, so I want to make sure we leave time for that. And then I think we're going to talk a little bit about the spending policy and set up kind of the stage for future discussions. So on the slide there and in front of you, if you would turn to the market overview, which is behind tab 1 and it's page 1, it almost seems, you know, like this was history. Well, it was history, but, you know, longer ago, because we're talking about the first quarter ending March 31st. Really outstanding returns across the equity markets, not only for the quarter ending March 31st, but especially for the 12-month period ending March 31st. Some of those numbers on the page almost don't even seem believable. You know, like small cap value stocks up 97%. So obviously that's a function of this time period starting April 1st, 2020 through March 31st, 2021. So it's almost like we started right at the bottom of the COVID downfall. But for the quarter, which is what we're really talking about today, those blue bars, we've seen really continued strong performance in the equity markets, driven by a couple things, you know, success with the vaccination rollout, as well as the continued stimulus that's pumping kind of growth into the economy, you know, increasing demand. All of those things are good for risky markets like equities. Fixed income, on the other hand, at the bottom of the page, has had a rockier road, so to speak. So over the last year, the gray bars, we have mixed results in fixed income. If you go 4 columns over where it says aggregate, that's the broad U.S. fixed income aggregate market. So that's the number that should give you a sense of what is fixed income doing, you know, big picture. And for the year, fixed income was only up 0.7%, and for the quarter, it's actually negative. So negative 3.4% for fixed income. So that's an important note for you to remember because of how heavily invested in fixed income you are. We still eked out a positive return for the quarter, but that's because some of your managers did better than the market. So I'll talk about that here in a second. And really, the fixed income volatility is driven by the Fed. Well, 2 things. The Fed keeping rates low, yet inflation fears kind of coming into the market, causing rates to jump up and down. And that's caused this fixed income volatility. So with that, I want to show you your performance on the next page. First, let's look at the market value in the middle of the page. You ended March 31st at $190 million, 122,504, and that represented a return for the quarter, just the one quarter, of 1.1%. So a reasonable quarter for this type of allocation. But really, if you look at that last 12-month period, it's just outstanding. Almost a 27% return in this portfolio. I almost hate to tell you that because I don't want you to expect that going forward.
We do from you.
I mean, that's just something I could have never really predicted in this portfolio with as much fixed income as there is. So that's outstanding, and that's really increased the bottom line, you know, that $190 million number. Now, taking this back to where we stand today, I want to make sure you understand that $8.3 million came out of this portfolio. So you took the funds out in April. So that $8.3 million came out. So your market value now is $187,453,196. So of course that's lower, but it's not lower by $8.3 million. So that tells you we've had continued growth. So here in the second quarter, so from April 1st through June 18th, you've had another positive 3% of performance. So year to date now, so from January 1st to yesterday, we're looking at a 4.2% return year to date. And as you know, we're approaching quarter end, so we're certainly hopeful for those numbers to kind of stay put because it's looking really nice. Real quick at the bottom, your manager stoplight, everything green there. So that means if everything's green, I'm likely not going to talk about an individual manager. So there are no issues with any of your underlying funds. I do want to kind of quickly show you on page number 4, in the middle of the page, where it says last year, and you see Port, so P-O-R-T, Porter County total portfolio 26.92%. Your evaluation benchmark was 21.49. So if we were to just take your whole portfolio and invest it passively in the market, that return would have been 21.49. So what that tells us is your managers, the funds that we've collectively chosen for your portfolio, outperformed their indices by, you know, gosh, almost over 500 basis points. And that's really unusual. So that was really exemplary outperformance, and it was mostly your fixed income managers. Your equity managers did fine, but they weren't really beating benchmarks. It was your fixed income managers.
We're busy.
Yeah. The fixed income managers were really avoiding and kind of actually capitalizing on all those interest rate moves during the quarter and year to your benefit. Obviously, the performance target is 5% because of the, you know, legislation and the spending policy, so we use that 5% as a bogey. Obviously, we are well above that. If you go all the way out to the since inception period, so dating back to April 1st of 2016, when all of this was put into place, you've now had an average annual return of 8.37% over that time. Again, that's much higher than we would have predicted, and that's outpacing both benchmarks. We can turn that into dollars. If you flip 2 pages, page number 6, that 8.37% on an average annual basis in terms of investment return corresponds to $64.7 million in investment returns for this portfolio. on a cumulative basis over time, you see that line at the top there? It's a 50% return, basically from where we started. So, all good news on the performance front. And that's, I guess I should preface, you know, we're saying all good news, yet I'm coming to you with a recommended change. So it's not because something's broken, it's because we're trying to get ahead of what's coming.
Amanda?
Yes.
You gave us where we're at
Yep.
to date, the quarter to date on the earnings. What are you seeing to date on the fixed income? Is there some
yeah.
other things you're seeing that are causing you to, in
Well,
this
we-
quarter, or is it a combination of last quarter and this quarter?
Oh, I mean, it's kind of been in the works for the
Okay.
last year. So
Okay.
you've got, you know, rates on hold in the short end at 0, yet you have pent-up demand, you have increased savings, you have, you know, people ready to spend, and so there's fears of inflation. So the long end of the yield curve is creeping up. And that means that, you know, anytime rates change along the yield curve, it affects the prices of fixed income. And we want your managers to have the most flexibility possible to either kind of pivot and change or take advantage or kind of get more defensive. And so long story short, we're gonna recommend that we allocate a little bit more money to fixed income managers who have more flexibility versus the ones where we say, you have to stay put right here, this is your mandate, and you have to have this amount of interest rate risk.
Is that predetermining the volatility in that space is why that's what the counter is?
That we expect more volatility.
Right.
Yes.
So we want those managers to have more
Yes,
flexibility? Okay.
yes, and I'll explain it a little bit
Yeah.
more. We've got some pages that
Yeah.
might make more sense. Your managers have done great, and even year-to-date in fixed income, every single one of your managers is positive. Positive, like, you know, 0.5% or 1%, not something to write home about, but positive. But we want to build a little bit more of that into the portfolio, expecting more concerns about inflation. You know, the Fed, you've got Fed governors some are voting or saying that rates are going to go up sooner than others. So there's not a lot of agreement right now. And when there's not an agreement, there's going to be volatility. Okay? Any questions on performance before we shift gears to the next presentation? It's the portfolio construction. It's behind tab 2. Now, I do want to take a minute. I'm going to be brief, but it's very important that we do this. As collective fiduciaries of these assets, you know, Capital Cities is a fiduciary, as are all of you. One of the things we have to do is confirm that the asset allocation is appropriate. And that can be an ongoing discussion, but we do like to have these dedicated checkpoints where we're looking at that. So on the calendar there, that's just showing you that here we are in the second quarter meeting, and that's what we're focusing on. On the next page, just a quick reminder of what does asset allocation look like. Well, long story short, our job is to basically help you meet your return needs, which are driven by your spending policy, without taking an ounce more risk, if we can help it. And that's how we derive our asset allocation policy, and that means our mix between equity and fixed income. Underneath that, there are less impactful decisions, things like, well, what style of fixed income, what style of equities, and that's where we have a recommendation. So it's a less impactful decision, but still important. On page 4, we wanted to just kind of walk through what is unique to this foundation and its investments. So we have the current spending policy just copied in there for your reference, and that certainly drives your, you know, return needs, because you want to be able to meet those without dipping into the corpus of the assets. In terms of liquidity, your liquidity needs are very low. We know that hopefully once a year we're transferring some money out, but that's anticipated, it's not a surprise. So we have relatively low liquidity, which is good. That means we don't have to keep a lot of money in cash. Risk tolerance, I say low to moderate. It's not as low as it could be, but it's certainly lower than most foundations. Time horizon, it's long, but at the same time, the fact that you're looking at those spending needs on an annual basis means that volatility does matter. So that's, you know, short and long. And then unique preferences, we say that, you know, everything is liquid in your portfolio. We could sell the whole portfolio tomorrow. Everything is traditional, meaning no hedge funds, no real estate, no private partnerships. And you have managers who are both active as well as passive. Page 5, this is something that we can't really control. When we look ahead and we look at what economists are predicting about the future investment markets, everyone across the board is predicting lower returns than what we've just experienced. That's what this page says. On an annual basis, we can actually, you know, get some updated numbers for you, and we have those. And they just keep going down, but that's actually not what has happened the last couple years. We've had really strong returns, but anyone out there would say, you know, over the next 10 years, the returns will be lower than what we've just experienced. So for instance, Callan, that's who we get our projections from, they're projecting that US equity will return 6.6%, and they're predicting that fixed income will only return 1.75%. So then on the next page, we can take your portfolio, so your asset allocation there on the left table, and we can run it against these projections and come up with a guesstimate at an expected return. And when we did that, the number is 4.1%. Last year at the same time, it was 5.0. So nothing has changed with your portfolio. It's just that the projections looking ahead are lower. So that is something that, you know, I wanted to make sure everyone sees, because if we're saying we expect this portfolio to earn 5%, it really can't do that realistically. It can't do that with only 40% in equity. Now, the flip side of that on the next page is if you were to try to increase that number, you have to add equity to your portfolio. So you have to get rid of some of your fixed income, and there's a trade-off there with risk. So for instance, on the middle of the page here, I just put together a 50% equity portfolio, and you can see that the expected return on paper goes up 0.5%. It goes up to 4.6%, but the projected risk, which is standard deviation, also goes up. This is more just for illustration. I'm not saying today, you know, pounding the table that we need to add to equity. If that was something that we wanted to consider, I think we'd have more extensive conversations. But I did want to just show you this illustration that there's no free lunch.
I don't know how we don't take a serious look at that.
Well, we do want to take a serious look at it. What I'm saying is I wouldn't just say, here's this page, let's do it.
Right.
That's what I meant by that.
But I think that this is a great intro into the smoothing conversation, because this will be what we're budgeting, well, what our spending policy determination is will depend on what we want this potentially to be. I know that sounds cryptic and I don't mean it to be, but page 6 and 7 are gonna be important for the smoothing conversation.
Yep. So what we would normally do is we would, you know, let me just use a different foundation, a community foundation in Indiana that has a spending policy of 3.7%. Then I would actually do the numbers until I arrived at a portfolio that equaled exactly 3.7%. I mean, that might be a little too manufactured, but that would theoretically say, here's exactly how much risk you have to take without taking an ounce more to get the return you need. Now, the question is, do you build inflation in? That's a whole different ballgame.
That's exactly what we want to do
Yeah.
now.
That's a whole different ballgame. So then,
Yep.
you know, if you're estimating 2.5%, 2.25 for inflation, then you really need to be targeting a return of, you know, 6.8%. And that's very problematic right now. Foundations across the country are all grappling with this same dynamic or dilemma.
I think it's important to note too, it wasn't all that long ago, within the last year, that we as a board were considering putting more into fixed income.
Yeah.
So, you know, these things do change, and like you said, there's a lot of volatility, and we really are in it for the long haul, so we have to be
Well,
careful.
And I know we're gonna talk about it. The smoothing policy would improve your time horizon,
Yep.
where you're not so
Yeah.
dependent on the market on one single day. And that's why we really couldn't, in good prudence, recommend more equity unless the smoothing is in place.
You get 1 year.
So Let me take you to page 9. So that's kind of big picture, equity to fixed income. What does your return look like? Now I want to make sure we get to that small recommendation we have. So in terms of your sub-asset classes, your styles of equity, your styles of fixed income, I wanted to remind you that last year we did a pretty big overhaul of your equity portfolio. We changed out some of the managers, and so we really think that's in a good spot. Fixed income, on the other hand, we were in the middle of a wild kind of ride in the fixed income markets, and we thought that it was prudent to just stay put, and it was very wise that we did that because your managers ended up having exemplary returns. So now we're coming back to you. Things have settled down a little bit, and we want to make these changes going forward. So on page 10, just by way of quick kind of education, when you look at fixed income, you have a lot of roles that your fixed income needs to play. We can no longer just buy a 10-year treasury bond and earn 6%. So we've got to get more creative with fixed income. So you need your fixed income to be a ballast against your equity, or you diversify your equity. You need it to be there for liquidity. You need it to be there for preservation, but you also need it for return. And that's really asking a lot out of fixed income when rates are so low. So we're trying to just be as creative as we can to make sure all of these things are happening, particularly when it's 60% of your portfolio. So when you see those little boxes, those are styles of fixed income. Those are kind of how the broad institutional investment world buckets fixed income. You have exposure to all of those things. Short story, and I'm going to show you pages here in a second. We're going to recommend that you reduce your defensive fixed because it's just a drag right now. It's an opportunity cost. And increase your diversifying. That's your most flexible managers. And they've proven that they can do a good job with that flexibility. So page 11, this is your pie chart of your different styles of management right now. The green, that's all your fixed income. So you have 10% in defensive fixed income. You have 2 managers there. They're doing great, but great means they're earning 1%. And that's really problematic. Diversifying fixed income, your managers have a lot more kind of tools in the tool chest to earn more. They can kind of play in different sectors, corporates versus mortgages, U.S. versus non-U.S., and so on. So we really just want to kind of swap out some defensive and put it into diversifying. If you look on page 12, you can see kind of the nuts and bolts of that. Basically, right now, in the blue box, that's what you have now. What we would recommend doing is just putting a line through that very last one that says paid in low duration at 5%. Paid in has done a good job for you, but we just think that that's, you don't really need that allocation. And then we would take that 5% and increase your diversifying managers. So those are the top 2 on the green, or excuse me, green, that's orange. My jacket's green, that's what I saw. So instead of those managers being 6% each, we're recommending that they're just 8.5% each. It's just kind of shifting the balance. We're not, changing this dramatically. It's just a shift. The reason we chose Payden over Baird, they've been very similar in performance. Payden is just a little bit more expensive, so that was enough for us to say, okay, we'll keep Baird and eliminate Payden. On the next page, while we didn't do this because of looking at past performance, we're doing this because of what we're thinking about going forward. I did want to at least show you that had we done this prior, it would have benefited you. So basically the orange is the new fixed income structure. The blue is what you have now. And we haven't even been invested for 13.5 years. That's just as long as these funds go back. Over that time period, you would have had an improved average annual return, not by mountains, but an improvement. So we think this is just a small change that is worth doing. And it's not because of any manager issue. It's just shifting the balance a little bit in a very tough fixed income market. But if you were to vote for this, page number 15, this is what your new portfolio would look like. It's still 40% equity and 60% fixed income, so it is a minor change.
Getting back to sort of what Jeremy brought up, if fixed income is so bad right now, and we know there's volatility in the future, I know volatility will also affect the stock market too.
Right.
But if we take this movement to smoothing,
Yes.
would that make more sense, you know, if we did take this step into smoothing, would that make more sense than to look at that asset allocation from fixed to?
Oh, absolutely.
Because I'm thinking, I think what Jeremy was, do we go to
Yeah.
the maximum 45? Because that's what our max
think-
is, right?
It's
55.
55.
55, okay.
I
I'm
should've-
sorry.
I should've-
I'm-
right now.
Right, okay,
We got
so maybe don't take it all,
So
but.
that's why we
right,
did
okay.
50, because then your rebalancing range would be +5, because it could
Ah.
creep up. We weren't sure how closely that would be interpreted. I assume, you see what I'm saying?
Yeah, I get it. I'm just thinking though, if smoothing is on the horizon,
Yep.
we don't know, that's up for all of us to determine, but I just think
Mhm.
what I'm hearing is, and you see it, if you
Yes.
watch the markets all day, fixed income's a wreck.
Yep.
And, you know, do we hedge there a little bit? And now we have the ability, if the markets change, we can move a little quicker because of smoothing, right? Or however we meet.
I don't think that would make it quicker, would it? I mean, unless we meet
We
more.
can make changes if we met.
We can do that now.
We can do that now? Just, okay.
It's just we're kind of protected
Right,
from the risk.
okay, got it.
I do think before we get into that, though, we should make a decision on this change before
Yeah,
we
yeah,
forget
yeah,
what
yeah,
you've
I
just
Yep.
said.
Fair enough.
So does anyone have any other questions real quick about this, this change from defensive fixed income to diversifying fixed income?
I'll make the motion to accept Capital City's recommendation on the move within fixed income.
Second.
Okay, I've got a motion and a second. All those in favor signify by saying aye. Aye. Opposed, same sign. Okay, motion carries. Thank you for bringing that to our
Thank you.
attention.
Yeah.
We like making more money.
So we will put the trade sheets together and run those
Yep.
by you
Okay,
tomorrow.
sounds good.
Okay, great. Do you want me to, you wanna jump in?
Yeah. That might, and then we'll
Okay.
come back a little bit. So,
Okay.
Does anybody have any questions about the report before we get into smoothing? All good? Okay.
Well, I guess, when do we come back and talk about possibly moving up from 40 to 45 or something in equities? When does,
Well, let's see if we
After we
get
make
through
the decision
smoothing,
on
because then we'll know if we have, what our risk is.
We'll see what our,
it's gonna make some more sense here
Yeah.
just in a quick second. If everybody turns to page 18 that's on the screen. All right, so what Capital Cities has provided for us on this represents our quarterly average with the percentage rates of what we would receive. So to make this make sense, here in 2021, everyone keep in mind that we have a foundation budget of around 5 million, 5.1 million, somewhere right in that range. Right now, based upon the spending policy, and I think also to give, to kind of complete the entire circle of why the one last part of this foundation for the county that's been difficult is, what we've heard a lot about is that spending policy, and then what are we putting our portfolio together to make, okay? So if you look at, and I know we're all very used to the 5%, one time a year, January 1st, December 15th, close of business December 15th, whatever the portfolio is made. If it's made at least 5%, we get that. If it's made more than 5%, the remaining over 5% goes back to principal. So on page 18, you'll notice that because of the average of our principal over several quarters, even at 4%, we would be receiving $6.3 million a year from our foundation earnings, correct?
Yep.
So that is a substantial, around $1.4 million more than our current foundation budget, and that's only at 4%. So the reason why Jeremy's very good question, it goes right in hand with this, is that
if this body adopts the ability to smooth, the next process that has to come is a committee to be put together to formalize what that spending policy is. And that spending policy is deciding, is it 3%, 3.5%, 4%, 4.5? It caps out at 5. But whatever that is decided, then that number comes back to what we were just talking about of how do we set the portfolio with the equities and the fixed income and the cash, taking into consideration inflation. So, if we had no need to grow the foundation budget, we could potentially be at somewhere between 3 and 3.5%, meet the foundation budget, potentially come back to Capital Cities and say, we want you to factor in some inflation, adjust our portfolio, and at that point in time, we would be going off the weighted average or the average of our quarterly principal totals. However, instead of taking 5% now, we would be able to give to Capital Cities, we are at 3.54% or 4.2%. Then that allows them to have that last piece of the puzzle in constructing the portfolio in a way that when they look out over a 5-year period of time, that's the projected growth. So that we could come in and say, all right, we want a little, we're gonna do 3.5%, that's gonna create on these numbers almost $5.6 million. We want to have enough money for inflation, so let's see what that portfolio mix would look like and come back. So that's why these two circle together so nicely.
And I think you should add that the inflation number wouldn't be coming to us, that extra percentage. It would be going back to the principal to
Correct.
build it up.
And what this also does for us is allows, because this is based upon the average of these quarters together, that average number is not going to greatly change up or down. So once we set the spending policy, then within dollars, we're going to have an idea very closely of what's going to be coming year after year, so that we don't have that December 15th roll of the dice of what's happened and not happened. What have we made as of this date, whether or not, it all comes back in 6 weeks or not, is beside the point. This smooths it out, that's where the term comes from, smooths it out, and allows us to go in, and I think the last large building piece of this foundation is, what's the formal spending policy? What is that percentage? Because once we have that percentage, let's say it's 4. Well, then that, along with some additional information from the board, gives Capital Cities that last bit of information to say, if you want to keep up with inflation at this percent, this is what your portfolio would have to look like, or if it's possible. If you want to take into account half of the projected inflation or no inflation, but that's the information they would need. I think there's a real good opportunity here through some more hard work to be able to come back and say, here's a spending policy number, here's some changes to the portfolio, and we're not taking all of the growth. We're at 4, we're putting together a potential, for round numbers, a portfolio that creates 5 on average. 1% is going right back to anything, anything above 4 is going back to principal. So that, again, because ultimately here, there's a here and now budgetary number that we need to protect, but there's also the future, $1 today, we're wanting to leave it to be the same dollar per power for the next, in a decade from now. So
Can I add one other thing too?
Together.
On top of that, right now, when we get beyond what we've budgeted, we've been putting it into our rainy day fund, where it's really not making any money. So instead, it would be back with the principal, whatever is between 5% and what our spending policy is, and it'll be making more money.
Correct. So the first decision the board has to make, and we need to have the full discussion, is do we want to opt into this? And then if we do, who's going to be on the committee to work with Capital Cities to get to that number? Obviously, that's going to be a partially budgetary, partially foundation kind of decision as far as how far this portfolio can go and the risk tolerance that this board has, which that kind of sets one end along with the bare bones budgetary current necessities that are budgeted out of that foundation. And then in between is whatever things there might be in there that we want to potentially grow, from this money or not. But I think this really, and this is the part of the puzzle that's made us difficult, correct? Because we're sitting at 5%, no matter what.
Right.
And it doesn't even mean, because we're not spending 5. We got 8.3 this year. That's 5%. We're spending 5 million. We're dumping the other 3 into our rainy day, and it's not making any
It's
money.
just sitting there.
It's making
Well,
money
yeah,
as much
little.
as it can be. It's not as if it, but it's
That's fixed.
it's at the normal governmental rate of having money. So that's forced us to create that rainy day holding account so that we don't run into a year in which there's no money. This would allow us to not have that issue, become the budgetary circumstances will become more smooth. And then I think there's a really good opportunity for us to set that spending policy and take into account inflationary concerns as much as possible, and come back to the question that was brought up by Jeremy and Jeff, as far as, is it time to go from 40% equities to 50% or 45, et cetera, which if everyone that was here when the original spending policy was put together, there was a choice to go at 15% less than equities at that time, and that was to, everybody, risk tolerance couldn't handle any more than that, dealing with public money. But now this allows us to make that full comprehensive foundation plan that I think the vast majority, if not all, and all is a strong word, but the vast majority of foundations have. Spending policy, they have smoothing, the portfolio set back towards, with an eye towards that spending policy, to put the full circle together. Questions or concerns for either one of us?
What's the negative? Is there a negative of smoothing? What?
I mean, it, not compared to what you're doing. Like, I think what, the problem with what you're doing now is it's literally based on one single day.
I look at the 2019
Yeah,
goose egg
that's the negative.
on that hysterical. It's sort of that too. But that's what I just keep looking at that 2019 number, and that's what,
And- yeah.
that says it all to me.
And I'm not,
Right.
you didn't have a choice with the
Yep.
way the legislation was
Yep.
written. So it's not something that anyone chose incorrectly. It's just very antiquated to be based on a single date. And then you have
Especially
no
the way the
ability
markets
to
have been
budget.
too, especially the way the markets have been.
So the benefit of smoothing is that you don't overspend when markets are great, and you don't underspend when markets are, or wait, I said that wrong.
Yeah.
Yeah, you don't overspend when markets are bad, and you don't underspend when markets are great. Did I-
That
somebody's
makes
gonna help me.
Yeah, you got it, you got it, you got it.
Take the second one.
Okay. So it's, it's just a moving average value. It's the same thing actuaries do with pension funds. They smooth out the value over time when they're,
I would like to ask Matt, as our banking guy out here, I'm not trying to put you on the spot, but just like to hear your comments and your thoughts.
I think you've all spoken to it very well. There's really no disadvantage to doing this. It's the most common way to do it when, as a foundation, you've got what is supposedly an infinite timeline.
Yep.
And so smoothing gives you that, it's the forced balancing act, and it keeps things consistent. You know what you can count on. They can give you great information as an advisor to where the investments need to be to hit that. Won't hit it every year, but over the long haul, you'll hit it. And, the only time it's a little uncomfortable is when you're pulling the 5% and the year was not so good, or the 4% and you were down. It feels funny, but you just have to force through it and realize that this isn't about 1 year or 5 years. This is about infinity, and it'll work out.
Yeah.
And I also think, to speak a little bit to the timing of what choices we had originally to the choices we have now, and that we didn't have this choice originally. But we also started off with 125 million, and now we're at 182 million. So, given.
We also
Yeah.
didn't have any quarters.
Right. Yeah, and that's true.
That's true.
Yeah, so we can
Nothing
name
is
the basis. What's our average? So, but when we were sitting here and, I think our total return since inception is 56% or something like that? 50%?
55.
But we still have a year that we got 0. And we've grown the principal at
And that
this.
put us, that year put us behind. I remember that. It took us almost a year and a half just to get over that.
And interestingly, in that 1 year, that was the only bad quarter too, right? The other 3 quarters were positive.
And that's why I don't like the December date, because December is usually when the
Rough month.
markets are the craziest. And that's the worst time.
Especially if there's an election or.
Yeah, the election, and that's what happened there. It was politics, so.
Vicki had something?
Just to chime in, at the end of 2018, the markets tanked. But what would have happened if something happened at the end of 2019? You would not have been able to fully fund the foundation budget fund, and we would have had to have come up with some
Yeah.
alternative plan, and you know what's in that fund. It's health insurance, it's.
Right,
911,
it's
Sort of important stuff.
Yeah.
Yeah.
Yes, no fluff.
Yep.
Thank
And
you.
that is that's telling considering how much this portfolio has grown.
Mhm.
It doesn't have a long-term growth problem, but it has a one singular day look-at problem, if you think about it that way. Since inception, we're at 50%. If Capital Cities would have told us that when we hired them, we would have called them liars, frankly. That's how well this portfolio has done. But yet, we had 2 years, 18 and 19, that were near misses. One was not a near miss, and then 19, brought us back out of it. So this smooths that out, and then again, we have the ability, I can tell you pretty assuredly, we won't take 5%. We'll be at something lower. Whether it's 3.5 or 4.2 will be decided with the help of hopefully a committee and then this full board, and then also with Capital Cities telling us what realistically a 5-year growth percentage would look like under current circumstances, will bring us into what that number needs to be. And then we smooth that out, and hopefully if the market is doing as well as it has been, knock on wood, we say that every year, then those additional funds would continue to go into principal, raising that level up, which then would potentially raise our 4.15% or whatever number I make up to put in there, whatever that percentage is would rise and or fall with the that quarterly averages over time.
One thing that struck me when I asked you how many foundations do it the way we are currently doing it, and I think your answer was 0 that you work with. Yeah. So you work with some pretty impressive foundations.
The trick is just not choosing a rate that's too high.
Right.
Then it doesn't work.
Yeah.
Then that's the disadvantage to your question, is if you use smoothing, but then you set an unrealistic rate, then you are setting yourself up for failure, which means eroding the corpus of the assets.
So we shouldn't look at a 7.5% return,
Nope.
to fund,
There-
Well, that wasn't an option.
That's private equity and real estate.
But
Yeah.
5 wouldn't be
That's the work
realistic
papers.
either.
And-
5 probably wouldn't be realistic when you take inflation into account.
Yeah, that'll.
Well, and I think again, some of the good work of the people that have been here through this process of building that foundation budget. We could be technically, gotta cover 5.1 million, and that could be 3.25%, if that's all we were doing, which allows that rest of the portfolio's, investment plan to be built around that. So we're not sitting here going, well, we have a $7 million budget, so we've gotta be at 4.8, what can you do, and inflation be damned. We don't have that issue, again, so it is difficult to come up with a negative at this point.
And let's face it, that foundation budget could ebb and flow too, depending on the budget process that you're all working on and how we move those pots of money around. Once we get all that put together, that foundation budget may come down. It may go up, but I think where we're sort of heading is that in itself, so It's just about having all the tools in the toolbox to be able to get there.
And to be clear, the only thing before the board tonight isn't to pick the percentage, isn't
Right.
to decide what to tell capital cities on the equities. This is basically to say, this is something we wanna do, let's get a committee together, let's figure out what percentage that is that we think we wanna be in conjunction with capital cities, come back to the board and say, the committee came up with X and this is why, and what's everybody think, and then we can have the full discussion if it's a point or two less, a point or two more, whatever those things may be. So this is for illustrative purposes only, because I think it's difficult. We've been running off 5%, whatever we make, it's 5, and then the 8 like this year, the 8.3 comes over, we move 5 point something million over to the foundation budget, we fund it, and what we've been doing is our own version of smoothing. Let's get 3 years of the budget in the holding account / rainy day account, and until we have 3 years of that foundation budget, we're not comfortable having any additional money. We're treating that as zero, and we still haven't got there. And so we would no longer have the need for that, because this would be a known factor coming in year after year.
I think as long as I've been out there, the people that sat on both of these boards have not made any rash, quick decisions. I mean, look where the principal's at now. This legislation, Laura has been working on for a couple of years. To me, and I wasn't jumping over anybody to vote for this, a year ago. It took me a little while to completely understand if this was the right move for us, and I think it is now, for myself. And, the timeframes, I don't know what we're looking at. It would make sense to me is, we pass this tonight, that committee gets together, and maybe if the times work out right, we could figure out what that budget is for next year, during the budget process. So, of course, I don't wanna rush anything, or be part of rushing anything, but again, we haven't rushed anything up here. This has been going on for a couple of years,
And we can always tweak of spending policy
Absolutely.
as we go.
So, I'm in favor of it, I think it's the right move right now for us.
I have a quick cash flow, thank you, Jeremy, question. How does the payout work in this? I mean, is it still on one date, or is it quarterly?
Normally one date, but
Okay.
I mean, it could be quarterly. All foundations are different. It usually aligns with their budget process, and the key thing is that we would just wanna have a little heads up of when it is.
Yeah.
But
Was that part of the legislation?
No, but I think it's an interesting point, because I do think it's a way to potentially squeak out a little bit more earnings at a small
Yeah.
level,
Well, that's
because
where
we're
I
not
was
pulling
gonna
out
have-
8 million at the beginning of the year, or 5 million at the beginning of the year,
Mhm.
where we only need, maybe
Yeah.
it's every, maybe like in this year, let's say we took 4 million in January and 4 million in July, there would have been $4 million potentially making our rate of return for the first 6 months.
What if we line it up, have Vicky take a look at it, and we line it up with our spring and fall installments too?
Yeah.
That might, help us cause we have to fund that budget out of that,
yeah,
those monies, so if you could line it up, right? I'm thinking of cash flow now, that's what I'm thinking of, so that's where I'd like for you guys to weigh in, what would be ideal for us to set that up, right?
Makes
Right,
sense, but
yeah.
it might be opposite too, where we might want it on the other for cash flow purposes. We might want it.
But that's again, I think
Yeah.
it's something, because in that first scenario, if we were getting 8.3 this year, if we got 4 million in January, and they knew we didn't need that other 4 million until July or August, there would have been $4 million more in there.
I think it's.
for or against you.
It goes up or down, but it's more available there for, assuming positive markets, it's
That's everything.
positive return, and assuming a negative market, it's negative, but it's something, it's small, and I don't wanna complicate the
Yeah.
issue.
That's,
The
No, but
cash flow issue
makes
would be,
sense.
I think, part of the discussion, but we're obviously gonna start with how much do we need
Right,
first.
get it, and then we tranche it out based on how it works for us.
Right. And it also may, and again, I'm break my own rule, a lot of this money's going to the non-for-profits. And so if the non-for-profit money's getting wrote right out, maybe that changes the cash flow question too, so,
Yeah,
because
that's
they're not
right.
gonna want.
Yeah. So I think I would like to have the treasurer and the auditor sort of weigh in on that with the group
Yeah.
so we can come up with those. So you might wanna give that some thought and let this board know what you guys think.
It would be part of that ultimate policy, because then that will be part of their information on the cash flow, because right now, one of the unique things is we don't need a lot of cash on the sidelines, so we do have the vast majority of our portfolio invested the way that our investment policy is. And
Yep.
so it allows us to maximize, it's good and bad, more money in, go up or down.
So the December 15th date is irrelevant after this?
Correct.
And we would either pick a date or decide to get paid quarterly or every 6 months?
Right. We could even say, we're gonna, our spending rate, I'll make it up, is 3.8%, and we want all of it on, January 31st of every year to fund the budgets, or January 15th, or whatever magic day we want, and then that would fund the budgets.
Like for other foundations, they have cash flows throughout the year. Like here's our flows out to not-for-profits, here's our scholarship
Yeah.
funds that are coming out. They come to us and say, hey, we need X amount of dollars. And we don't actually check that it's fitting their policy. So that's something else that's kind of unique. Like, I don't go to any of my foundations and say, oh, it looks like you've spent a little bit less than your policy this year. So that's another unique thing with this, it's so specific. So we'd have to talk about how we do that, because we're not accountants.
Right,
I guess
right,
what I'm trying to say.
right. No, and we have to make sure we stay within our,
And so if
I'm not either, but I stayed at a Holiday Inn Express.
so you would, even if the money didn't come out, you would have to calculate it at some point.
right, that's what I'm thinking
And then
about.
that
but-
calculation can't change every time the market value changes. So these are nuances, though. This-
Right. I don't want to get in the weeds too far, but we
Right,
do need to
right.
talk about that.
So, Madam Chairwoman, so moving forward, going through the packet, we have a couple resolutions, right? That
Yep.
would,
Let's-
you want to explain briefly what, if we were to move to smoothing, is this what, this
Yeah,
first
This
resolution?
is the first resolution, and
Yes.
Scott, you want to go over that briefly since you wrote it?
A resolution to adopt the formal spending policy, so it just goes through, describes that House Enrolled Act 1407 amended our code that allowed us to be created, 36-114-3. It allows us to adopt the formal spending policy within our investment policy that would allow up to spending rate of up to 5% multiplied by 5-year moving average of the quarterly market values, or in the case of a foundation that's established less than 10 years ago, an interim spending rate of up to 5% multiplied by the moving average consisting of all available quarter market values. And then this would also have a committee that then you guys would need to decide on who would be on to start digging into what would be the percentage for the formal spending policy.
So what's the next resolution?
After that, the next resolution would be to repeal the rainy day holding account guidance that we had passed on 2/27/17. That resolution just stated that we wasn't mandatory, but it was the goal of this board to have 3 times the then budgeted foundation amount in the holding account before we were to spend any of that additional money that was sitting there.
So just for clarification, I mean, if we pass this first resolution, then there's really no reason for a rainy day fund, because we're moving to smoothing, and there's just no reason for it.
Correct. I mean, the number, we won't be able to say we're getting 6,399,000, but we would be able to say we're gonna be able to cover the budget within a couple of dollars. I mean, it's gonna be pretty close on the estimates every year, depending on what, because we all know the quarterly averages, and that we would just be waiting for one last quarter to add to the mass of other quarters to average together. So we will know very, very closely what that dollar amount is, so therefore we lose that risk that we're currently sitting on, which is, what if the foundation doesn't make any money in that given year, based upon that 1 year look, that 1 day look, of December 15th.
How much do we have in that? Vicky?
On the holding account,
Mhm.
10.28 million.
2.8 million?
And that is after the transfer from the holding account to the budget. So it's 10.2, is it 10.2? 8 to 9.
Well, just keep things moving forward. I mean, just to put it out there, I'll make a motion to pass the first resolution to adopt formal spending policy with Investment Policy Foundation pursuant to Indiana Code 36-1-14-3 D2 and Indiana Code 36-1-14-3 G.
Second.
Okay, we've got a motion and a second. Any further discussion? Just have one quick question here. It says consisting of all available quarterly market values since the date the foundation was established. Should that be like 20 quarters? Because shouldn't it be like a rolling average? Otherwise, we'll just end up with more and more and more quarters.
I think I pulled this right out of the statute,
Okay.
these two. I'll double check.
That's if there's less than.
Yeah,
Yeah.
if there's less than 10 years.
Oh, I'm sorry. Okay, I missed that part. Okay. Yeah, you got it, sorry.
Sorry.
Scott, is there
Alright.
anything on here from the House bill that we have to adopt separately, or is that all part of these
It's within
ordinances?
this,
This is
yeah.
part-
In that,
It-
okay,
this is-
just
yes.
making sure.
Yeah, because it's
I
an
figured
option.
it was, the way it was.
The way the statute, the way the state changed the legislation is, we're not, this isn't
Change it.
mandatory.
Right.
We can stay the way we are,
Or
or we can opt into this.
And this is opting in.
This is opting in and resolving to put together a formal spending policy.
Yep.
And I guess I was just one last thing, just for clarification, Sylvia and I talked before the meeting, and if this doesn't work, it is Mike Jessen's fault.
Well, I'll accept
like that.
responsibility.
Big shoulders.
All right, all those in favor signify by saying aye.
Aye.
All opposed, same sign. Motion carries.
Moving, baby.
Let's
Deal.
do the
Thank you,
committee. You guys
everyone.
want to talk about the committee real quick?
Yep,
Yeah. Yeah, I'm sorry, what?
talk about the committee. So we need to put together a committee to establish the spending policy. I was thinking, and I'm open to suggestions, that myself and Mike Jessen as the president and vice president of the foundation, and then the two presidents of the boards or their appointee. And I don't, do we need anyone further? I'm open.
Kind of makes sense to begin with. I mean,
And
if I get any feedback, or if somebody wants to jump in my spot, as you said, or appointee.
And of course, all of us, I think I could speak for everyone, would be welcome to ideas and input. Okay, so do we need to vote on that, do you think? Okay. Motion to put together a formal committee on a spending policy that would consist of the chair and vice chair of the foundation, along with the president of the two boards, the council, county council, and commissioners. Anybody can?
I'll make that motion.
Second.
Okay, all those in favor signify by saying aye.
Aye.
Opposed, same sign. Motion carries. All right, great. You want to move on to,
So I guess if, so this gets rid of our kind of
Our guidance.
resolution, our guidance. I mean, and you think we need to do this, pass this resolution? Just makes sense, good housekeeping?
Yes.
for the rainy day
The
fund?
rainy day fund repealing our resolution. I'll make a motion to pass, number to it, Scott, just, the resolution repealing, the resolution establishing guidelines for rainy day fund with foundation holding account.
Second.
Got a motion and a second. All those in favor signify by saying aye.
Aye.
Opposed, same sign. Motion carries. All right.
And obviously, that committee will be working with capital cities so
Yep.
that we can have the two issues come together as far as the policy and the, how the investment policy, if it changes.
Where you going, Scott?
Back to
Going
his,
back to my seat.
so we still
All
have.
right, we're
the-
still
yeah.
on the attorney's report.
Oh.
All right, so the third thing we have is the proposed motion to move $3 million from foundation holding to the foundation budget, subject to council appropriation, of course.
So moved.
Second.
Okay, all those in favor signify by saying aye.
Aye.
Opposed, same sign. Motion carries. Any other matter that will come before the board, we need to approve the claims. Capital Cities, second quarter, $16,250.
So moved.
Do I have a second?
Second.
All those in favor?
Aye.
Aye.
Opposed, same sign. Motion carries. Does anyone have anything else?
The only thing I'd like to say is I think the work that we've done tonight is extremely important as we move forward with the foundation, and as I think it's important to reflect back on 2016 when this started. And I think the board has had collectively a very conservative, disciplined approach to managing that money, which is so important to the people of Porter County. As a result of it, we've had great success. When you look at the figures showing that, knowing that prior to the original legislation, we were making less than 1% return.
Fixed income.
And here we are today, since 2016, at 8.37% since inception. And as you look at the dollars, of course, they correspond with that, which I think we can all be very, very proud of. But we're not resting on our laurels. We're saying there's more that can be done. I think to put together an effective spending plan is a natural next step. It fits in line well with what the county is doing relative to our work with Baker Tilly and setting up that 5-year spending plan, talking about capital expenditures over the course of 5 years versus a very narrow window, which we've looked at intentionally with the foundation and also spending at the council level. So I would just like to say for this House Bill 1407, sponsored by Senator Charbonneau and also Senator Talion, we thank them and appreciate them for the work that they did carrying the load, and not at all forgetting Representative Soliday, who was the person who worked with us so closely back in 2016 to put that into place that allowed all of this to happen. So we certainly send our appreciation to all of them who helped us in this work. So I think it's great work, and I'm looking forward to taking the foundation to that next level. So I think it's great work.
Well said,
I'd like
Mike.
to add to that it's nice to see some bipartisan work, things that are good for the county, for all of our citizens, and we put politics aside, which is not happening everywhere in this nation right now.
That happens
So
here every day.
congratulations to all of you for that. Anything else? Okay, until next time.
You wanna schedule a date?
When is the
Oh,
next time?
yes, next
There
time,
we
thank
go.
you. Almost did it
Trying to run
again.
out of here. Whoa, hold that.
I would say the August, before the August council meeting.
Yeah, I think 60
What's your
days.
date?
60 days and give the committee plenty of time to get their stuff together, I
Is
think.
that the 24th? August 24th?
Just trying to keep it easy for the council.
Oh, appreciate that. August 24th, is that right? Joy, is she in here? Yeah, it looks like it.
Does that work for you?
Look at her.
I have surgery at 7 a.m. on the 25th.
Well, you can make it here by night.
You got some prep to do? I mean,
We can get your room up at Porter,
A room-
Northwest Hospital,
Oh,
Northwest
I-
Hospital. I
I-
forgot it's not
Stay in
Porter.
Indy.
I guess
No, we
I
can
can
change
do it.
No,
It's just-
we can change it.
I already know what life is like as a mom preparing
I
to
gotcha.
I
be
don't,
out for a little while. I'm so sorry.
No.
No, it's why
What
we're-
about the
why we're
23rd
working through
again?
I had a little knee accident 2 weeks ago.
The day before, the 23rd?
That would help immensely. if I
Yeah,
could-
that'd be
I'm
okay.
so sorry.
Would that work for anyone else?
What day?
Monday, the 23rd?
Oh, yeah.
you gonna put that in there, Greg?
Yes, I am putting it in here.
I
Scott, would that work for you? Monday, the 23rd of August? Okay.
Thank
Then we
you.
stick around 6
Thank
weeks.
you.
Yeah, no problem.
Amanda, you've been a great part of this success too,
Yes,
so if we can move a
yes.
date for you,
Well, thank you.
we'll do it.
I immensely appreciate it. I just know how life will be that evening.
Not all the time, though.
Hey, anything for a 9% return.
All right. What time?
5 o'clock?
Yeah.
That's a good time? Okay.
That's a floating package.
Yeah.
Sylvia wants you all to be on
So,
time next time.
Shall we set up a committee meeting offline, like separately?
Yeah, let's do that.
Okay.
All right, thank you, everyone. Thank you, Amanda.
Good deal.
Thanks, Matt.